Hey guys, welcome back. Patrick here. There is massive market manipulation right now when it comes to the SPAC mergers. In this video, we are going to talk about the massive battle happening between the shorts, including myself, and the people trying to artificially create short squeezes. Did you guys see recently BLUW, BLUW, went up over $25 based on this short squeeze? It was very short-lived. In this video, I'm going to reveal exactly step by step what the pattern is and what's going on, and you guys will be able to see why my strategy has been working and their strategy is probably still working also. There's two ways to play this game. All right, so let's get started. Quick announcement: I'm going back to Canada for 3 weeks. There should be minimal disruption. I'm still going to be making 1 or 2 videos on YouTube per week. So let's get started, and thank you for watching. Alright guys, there is a lot of manipulation right now going on with the SPACs that are about to merge. I've been playing one side of the trade, other people have been playing the other side of the trade, and I do believe that the SEC is going to get involved fairly soon because there are going to be a lot of bag holders in this situation. What's going on, just to really sum it up very, very quickly, is that there is a redemption period for these SPACs. You guys know that they are at the artificial $10 floor, right? You can see it with this SPAC, BLUW. For the entirety of when it was a SPAC, it was stuck against $10 because worst case scenario, you can trade in your shares and the company is going to give you your money back, so $10 approximately. All right, so that gives the company a floor of $10. Well, what happens is a couple days before the merger, this floor disappears, right? Because everyone that wanted to redeem, there is an expiration date where after that you can't redeem your shares anymore. And so their $10 floor no longer exists. Well, what happens is that in the market, there are arbitrage funds that own millions of these shares, right? And their entire goal is to only buy it for, let's say, $9.75 and then redeem them for $10 and collect that profit, the 25 cents spread between those two numbers. So the thing is that they actually redeem those shares, but they still vote in favor of the merger, right? So let's say that there are 50 million shares in circulation. Well, now, since in some cases up to 97% of the shares are redeemed by investors that know the stock's about to crash, so they want to get the heck out of there, that means that from 50 million shares in circulation, this drops down to, let's say, 1 million shares or 2 million shares. And that creates almost no liquidity in the market. And what happens is you can see cases like these where BLUW, right before the shareholder meeting, actually went up to $31. It's very easy. All you need to do is you have people that aren't selling, you have people that are bidding up the price artificially, and that creates a short squeeze. Now, I'll give you another example, very recent, LWAC acquisition, LWAC. The shares currently are $16.98, but if you notice, look it out in the past week, it actually skyrocketed up to $69.55, and then now it is actually crashing back to where it should be, which is currently at $17, and it will continue to fall lower and lower and lower because, to be totally honest, these SPACs are pretty much trash. No one cares about them. No one is trying to go long on these companies. That's why the redemption rate is above 90%, right? Almost everyone that has shares of this company redeemed for cash, to the point where often they don't even have enough cash left to satisfy the requirements that they negotiated with the SPAC. I don't remember which one, but they were supposed to bring 100 million to the table, and because of all the redemption, they have about 60 million left. Right, so they're going to have to negotiate with the SPAC to try and get their approval for the transaction to even go through because of all of these redemptions. So what happens, as you can see, is a couple days before the merger vote, the floor drops, right? And I'll show you a different example. This is a better one. This is Snapper. Volta charging. I do not have a position in this one. All right, just to let you guys know, I tried to open one, but I wasn't able to. So I'm going to show you exactly what the stock is doing, and you're going to understand the strategy. So this is going to be when the redemption period ends. After this, you can no longer trade your shares in for $10. Right? So the reason why is there's a settlement period. As you guys know, it takes about 2 days. And in some cases, even some brokers will not let you do the redemption like 3 days before, because, you know, some of them are not as efficient and they don't think they'll be able to do it. So this is the date when the redemption is over and the floor of $10 disappears. So what happens then, as you notice, it starts to crash. All right, so this is what happens all the time, and that's why I have been buying puts on these SPACs. Right, and my profit comes when the floor drops and the SPAC starts to collapse. But here's what happens right here. As you notice, we're starting to see a big shift, and this is when the number of shares in circulation disappears. In the case of Volta charging, 70% of the shares were redeemed. So let's say that in total there, I can't remember exactly the number, but let's say that there had been 100 million shares in circulation. All of a sudden, you wipe out 70 million of them, you only have 30 million shares. So if the demand for the shares stay the same, right, people are going to be more interested in the stock at what is this, 866 than they were at $10. Well, as the demand goes up and the supply goes down, that's going to create a short squeeze. And that's how you got Snapper that went back up over $10. All right, and this, after that, what happens is the opposite is also true. Once the merger is complete and the ticker changes, sometimes, like with Joby, you are going to see, let's say that this is the merger date, right? Sometimes you are going to see a little bit of excitement and the share price is going to go up. In the case of Joby, it went up to 1350. And then after that, once people like there's more shares in circulation, there's always going to be people that are going to collect their profit after this short squeeze, and then there are the institutions that are going to be shorting the stock. Then after that, it's going to go back down. Right, so this is the strategy that's been working, and that's why personally I can make money here when the floor drops and the shares go down, and then they are making profits by either buying shares here, and then as you can see, look at the massive green candle. They artificially make the price of the shares go up because the float is so low, so it is very easy for them. Like they only have to spend $100,000 or $200,000 and the share price is going to skyrocket. All right, so that is how it works. If you look at XOS, you are going to see the same thing, but a little bit differently. All right, so this one, as you notice, this is when the actual redemption period ended, and this one started to go down immediately. Now, there was a little rally, if you notice, right around here, and the shares went back to almost 950, except this is a stock that doesn't have the same type of enthusiasm, or people didn't know the strategy as well back then, right? Just a week ago, like the strategy shifts very, very rapidly the more people know about it. So this one never went back to $10, $11, $12. So the rally was only up to about 950, and then it started to crash once again. And look at how it keeps trying to rally up, and then it still continues to go down. So anyone holding puts on this company is making tons and tons of money. Right, so that's why personally I have been playing the downside, but there are some cases where, like Snapper, you are going to see an upside also. So technically you could play the downside and the upside, but that requires a lot of timing. So personally, I'm not doing it quite yet, right? But I am working on some of them, and I do have people in the group that are playing both sides. So personally, what I've done is I've opened fairly big positions in a lot of different SPACs that are going to be merging soon. And this battle that I've been telling you about plays out in a company like SOAC. This is a very, very poor SPAC, all right? It's a company that has a shitty business model. They are trying literally to go fish out rocks from the bottom of the sea. They have about 1 million in revenue, and the company is priced in the billions, right? So we all know that this is a junky SPAC, and there is going to be a lot of redemption, and the price is going to crash. There's almost no doubt about it. But if you notice, look at the open interest for calls at $10 of almost 8,000. And then you have the puts at 750 that are almost 11,000, and then also people buying them at $10. This is the big conflict right now. There are people like me. I have 200 of this one at 750 that are playing the downside, and you have people that are playing the upside. So it is very possible that we are all going to be making money with this, because as I showed you, the stock tends to crash and then rebound, and then often after the merger, let's assume that this is the merger and the ticker changes, after that it crashes once again, like we saw with some of the SPACs recently. As before I wrap up, here's two more examples to really hammer this home, and I'm going to show you how it played out for some of the ones I already opened. If you guys remember, I had contracts on Joby, and some of you were a little skeptical about this one. Well, it ended up doing very, very well because of this exact pattern that I showed you in this video. Look at how Joby actually went up to $14 on the day the ticker changed, and my 25 cents puts were not doing that well. But then, as we all predicted, it actually crashed all the way back down to $8.50, and I was able to sell my position for 65 cents. All right, so I bought them at 25, sold at 65, or at least a portion of them. I took profits, and I let a little portion ride. So this play has been very, very successful, even though the stock has recovered since then. So I'm not going to try to be right on 100% of them. It's a numbers game. Some of them are going to go straight down like XOS and Otmo, and some of them like Joby are kind of going to behave a little bit different. As long as we have that period where it drops under 10, I'm going to do fine on most of them. This is Otmo that I was just telling you guys about. This one, exactly like XOS, has crashed all the way down to under $6. It has recovered a little bit since then. You know, since the past week, the market has been fairly green for all of the small cap stocks. But overall, as you can see, I mean, it is a strategy that has been working fairly well and will probably continue to work fairly well, unless all of a sudden you have all of the vultures that really do all of the short squeeze and it never goes back down under $10. Personally, I'm buying them really cheaply, so I am willing to take that risk. But it is the stock market, right? It is very unpredictable. These are very heavily manipulated stocks, so I can't use the G word, guaranteed, that's always going to work. All right, so here are my positions currently. SOAC, this one is going to have the shareholder meeting on the 3rd of September, so the floor should be gone in a few days on September 1st, maybe the day before. Some brokerages are a little bit more sheepish about allowing people to redeem. Then QELL, SFTW, Black Sky, ACIC, and then SRNG. I have 200 in 4 of those, and I have 380 in ACIC. All right, so I don't have a judgment on any of these SPACs. Some of them are really bad. Some of them may end up being really good. I know a lot of people like Black Sky. A lot of people like Ginkgo. But it doesn't really matter. Here, the goal, like the strategy, revolves around the market forces on the merger itself, not on SPACs in general, not on the quality of the company itself. It is literally market forces that are manipulating the share price down at first, and then usually goes back up. I hope it makes sense. I hope you guys enjoyed it. I'll see you guys in the next video.